Getting a lot of questions on when the right time to buy is in this market. As you know, interest rates are rising, and we're in a pretty volatile lending environment. So my answer is there is no right time to buy, but if the asset fits your criteria, after you go through your due diligence, your analysis, your exit strategies, if it still fits in this environment, I would say pull the trigger and move forward. There's a saying that says, date the rate, marry the asset. So interest rates, will change. I don't have a crystal ball, so I don't know if they're gonna start coming down in a year, 2 years, 5 years. I don't know, but historically, we're probably at the median of interest rates right now. So if the asset fits your buying criteria, I would say, go for it now. Trying to time the market is dangerous. If there are billion-dollar companies and they don't have crystal balls, they can't tell you when the top and the bottom of the real estate market cycles are. So you just have to do your best. Like I said, do your due diligence, do your research, and have your exit strategies lined up. A lot of syndication groups, a lot of investment firms, they have to continuously acquire assets, and that has gotten a lot of groups in trouble in the past 12 months. They pay their employees, they pay their rent, their utilities, their software off of acquisition fees, and that has gotten some groups into some hot water. So what we've been seeing is in the major metropolitan markets, already assets being turned back to lenders because those groups had to buy, and now they're upside down, and they're giving properties back. So I do think there's going to be some opportunity taking advantage of those situations in the next 12 months or so. But they were forced in those situations. So if you're not forced to acquire assets, take your time, be patient, and like I said, match up your criteria and your exit strategies, and then pull the trigger and go after that deal. If you're waiting for another 2008 crash to happen to jump into the market, that's likely not going to happen. Banks and institutions are way more favorably leveraged than they were in 2008. So things that are going to happen is equity is going to get wiped off the table when lenders take back properties, but it's the equity that's wiped off. They're fine. They're going to be 65%, 70% into that deal where they could put it on the market and probably even turn a profit. So there's not going to be that huge crash of 2008, at least in my opinion. I think the lenders are way better positioned. So the smart investors, they're going to take advantage of the market, but just know it's not going to be pennies on the dollar like it was in 2008, 2009. So that is the reason we moved from a closed-end fund to a evergreen fund. If we were to buy, in the last 12 months, we were at the top of the market, 5-7 year hold. We don't know what cap rates are going to be at the exit. So we pivoted to an evergreen strategy where we can buy assets now, we could buy assets when on the way down, and we could buy assets on the way up. And using that diversification, spreading that risk out, we feel like that's the better long-term strategy for building wealth and spreading out risk. So, we are in a unique situation where, yes, I think we are facing a bit of a downturn in the investment real estate market, but we are poised to take advantage of it.